Hello and welcome to preparation of financial statements series. In this session also we'll try to prepare the cash flow statement showing CFO, CFF and CFI when the balance sheet, income statement and cash flow statement is given, and in this case cash flow statement shows the receipts and payments. But as mentioned in the previous session, it is necessary to show the CFOs, CFF and CFI in the cash flow statement. The CFO using the direct method will show the cash inflow from the operating. So in this case is the sales and advance from customers minus the expenses paid and minus the tax. So cash from operation is 69,800. Cash flow from financing decision, there is no inflow from the financing decision, but there is an outflow because of interest. We are treating interest as a financing decision and the dividend payment. So there is a negative cash from financing 31,000. CFO, CFI, investment decision. We have received dividend is an inflow from investment decision, and there is an outflow of purchase of shares. So there is outflow, the cash from investment decisions negative. So cash from financing decision negative 31,000, cash from investment decision negative 30,000, and cash from operating decision 69,800 positive. The summation of opening plus CFO, CFF and CFI will give closing cash in hand, which we already calculated as receipts minus payment. Now next we will try to answer and address this difference between the PAT and CFO. PAT is 58,800 whereas the CFO is 69,800. So the question is, why is PAT not same as CFO, or why is CFO not same as PAT? We know that PAT is not same as CFO because of non-cash items like depreciation, non-operating items like interest, dividend, and the changes in the working capital or changes in the current assets and current liabilities which reflect the credit transactions. So in this case depreciation is 8,000, we added back because we deducted while computing PAT. Interest we added back because we deducted while computing the PAT. And we deduct the dividend because we have added while computing the PAT. So non-cash, non-operating expense and non-operating income. Now the credit items are reflected by seeing the balance sheet. So the credit items are reflected by seeing the changes in the current assets and current liabilities. So outstanding expense, there is an increase in outstanding expense. That means during the period we have not paid expense to the extent of 10,000. Increase in the creditors, that means during the period we have purchased goods on credit. Increase in advance, that means we have received advance from the customers, so therefore it's a cash inflow. There is an increase in the debtor, that means we have sold the goods on credit, no cash inflow to the extent of 120,000. And decrease in the stock, that means the stock purchased in the last period have been used in the current period. So these 5 items reflect the credit transactions, advance received from the customer. So the changes in the current asset and current liabilities will reflect the credit transaction. So as a result, CFO is not same as PAT because of depreciation, because of interest, because of dividend, and because of the changes in current assets and current liability. Thank you very much.